What is term insurance? Term insurance is a type of life insurance policy that provides coverage for a certain period of time or a specified term of years. If the insured dies during that time period specified in the policy and the policy is active or in force, then a death benefit will be paid. It is usually best for additional short-term coverage due to a sudden increase in liabilities and commitments, or if the insured is confident that years down the road when the term expires, he or she will have no financial dependence or liabilities to be worried of. So here are some of the benefits of term insurance. Number 1, term insurance is affordable, less expensive. Term insurance is an inexpensive option for those who have other financial commitments and require immediate attention. Number 2, it provides you more flexibility. It allows you to choose how long your liabilities and commitments should be protected for. So let's say, for example, I do have a mortgage. Buying a term or decreasing term insurance for that kind of liability is a fantastic idea because you know exactly what the end point is, so you don't need to buy a whole life product to be able to protect just something that has a fixed liability. Number 3, it is great for short-term needs. Term insurance is a very good solution for protecting commitments which are time-bound and have a fixed duration like mortgages, business liabilities, personal loans, and kids' education. So what are some of the disadvantages of term insurance? Number 1, when the term insurance expires, it will be more expensive to purchase life insurance. Once the term is completed, you have to apply for a new one, and at that point, you might not be medically or physically able to get one. Number 2, the policy lapses if you don't pay the premiums on time. You have to pay your premiums on time. Even if you skip one premium, the policy can potentially lapse. Number 3, lack of flexibility. There's no flexibility available when it comes to term life insurance. If you want to increase your cover or reduce your cover, change your term, you have to literally apply for almost a new product. Now let us illustrate this with a case study on term insurance. Let's say we have Peter, a 50-year-old father, which is a sole breadwinner with a wife and a kid that is 6 years old. Like most family, Peter owns a house that is on mortgage. Should Peter pass away one day, a certain amount of money will be required to firstly support his family, secondly support his kids' education, and thirdly to pay off his mortgage. Peter should buy a term insurance under these scenarios. Number 1, he is confident that his kids and wife will not require any further financial support in X number of years when the term insurance expires. Number 2, Peter is confident that he will pay off his premiums on time so that it will not lapse. Number 3, Peter currently can't afford a life insurance which is more expensive but requires the amount of coverage. In this scenario, buying a term is a good temporary solution. Number 4, Peter knows that his mortgage will be paid off in X years and is buying a term insurance for protecting commitments which are time-bound and have a fixed duration. In general, term insurance is best for short-term commitments that can be predicted.